Assalamu alaikum friends, welcome to SBR revision series for September 2021, and today we are going to cover leases, Ifrs 16. So let's start with the topics that we are going to cover under leases: definition of lease, and identification of lease in a contract, lessee accounting, lessor accounting, and sale and lease back. There are two types of accounting. One is for the lessee, one is for the lessor. For lessee, we have to recognize lease, liability, and right of use asset. And how do we do that? And for lessor, it's operating versus finance lease and sale and lease back. Okay, so let's start with some definitions under leases that we have to know. What is the meaning of lease? See, lease is any contract, okay, that gives you a right to use an asset for some time, but for using that asset, you have to pay to the one who is giving you that right to use an asset. That is the meaning of lease. Under IFRS 15, we went through a contract, but that contract was for contract with customers, okay, revenue from contract with customer. That is for satisfying a performance obligation, for selling a good or a service, right? Lease is not like that. Lease is also a contract, but this contract says you can use an asset for some time, but for using that asset, you have to pay. Okay, let's say you're using an asset for 3 years. For that 3 years, you have to pay to the person who have given you that right. Okay, so the lease contract and the contract under IFRS 15 are two separate contracts. The reason I'm telling you now, because sometimes the examiner gives both of this together and try to confuse you. Sometimes they will give you a contract which is not containing a lease in it, but you might incorrectly think it's a lease and you might use IFRS 16 rule over there, right? Sometimes a contract is a lease, but you think it's not a lease. So that's the reason. To avoid this, we need to know what type of contract a lease in, and we have to identify also. Now, the second, lessor. So we have to know the parties to this lease. There are two. One is known as lessor, the other one is known as lessee. Lessor is the one who has given this right. It's his asset. He has given this right to use the asset to the person known as lessee. Okay, so the lessor is the one who is going to receive the consideration. From whom? Lessee. So lessee is the person who is using this asset, and he is the one who has to make this payment to the lessor. Okay, know very clearly who is a lessor and who is a lessee. You cannot get confused with this two. The reason is because when we come to sale and lease back at the end, most of the students get confused. Who is the lessor, who is the lessee, what are their properties, what are they supposed to account for? Because lessor accounting is separate, lessee accounting is separate, and when it's under sale and lease back, it is more confusing. This is just a normal lease. It's easy to understand. I have taken on a lease. I am a lessee. The person whom I have taken it from is a lessor. But under sale and lease back, it becomes confusing. That's the reason. Know clearly who is a lessor, who is a lessee. Now, identifying a lease is very important. Not every contract has a lease, right? So, to identify, okay, that it's a lease. So, a contract contains a lease if it conveys the right to control. How do you know? It should convey the right to control the use of an asset for a period of time. Identified asset. The asset has to be identified for a period of time in exchange for consideration. For this, the contract must give the customer to use the asset. Okay. The right to substantially all of the economic benefit from the use of that asset. That means when the asset is being used, who is going to get the benefit? Customer. The customer is the one who's going to take the most of the benefit out of it. The contract should give this to the customer. Second, customer has the right to direct the use of the identified asset. Okay, they have the right how they are going to use that asset. If they don't have the right, then it's not a lease. Please understand this. If the contract does not have the right to use the identified asset, nor they are getting the benefit from that asset, it's not a lease. Okay, so both of these conditions has to be there. They should have the right to direct the use, and they should have the right to all the benefits from that asset, from using that asset. Okay, then it's known as a lease. Sometimes lessor. Okay, this is given in the past paper question. That's why I'm telling you. I have not mentioned it here. But Lessor sometimes tells that, for example, you are taking a vehicle on a lease, and the Lessor tells you that you cannot take your vehicle or your car from this area to this area. So that does not mean that you don't have the right to direct the use of the identified asset. No. Here, the Lessor is just reducing your scope, that you cannot use that area. He's just reducing your scope. He's not preventing you from the right to direct the use of the identified asset. You still have a say on how you are going to use that asset. Okay. So please identify this. This is there in the past paper. Make sure that you go through this. You must have gone through this issue. That's why it's very clear to identify what is the meaning of right to direct the use of asset and what is the meaning of reducing the limiting your scope. Okay. Next, we are moving to the lessee accounting. So we first start with the lessee accounting. Okay, because mostly the exams also exam questions are also about lessee accounting more than lessor accounting. Okay, then we will focus on lessor accounting and then finally sale and lease back. So lessee accounting says initial treatment. How do you initially treat lessee accounting? Number one, okay, you have to recognize two things. All lessee have to recognize two things when they have started the lease. Number one, right of use asset. Number two, lease liability. Because he's going to use that asset. See, lessee is the one who's going to use the asset. That's why right of use asset. Second, lease liability. Why? Because he has to pay to the lessor. So now does it make sense? Lease liability right of use asset is recognized by lessee and not by lessor. Okay, with the exception, there are some exceptions where you do not recognize a lease liability and right of use asset. Those exceptions will cover a little bit later. But first, let us go by the normal way when we have to calculate lease liability and right of use asset. Okay, so how do you calculate the liability? Okay, always start with the lease liability and then the right of use asset, because you need the figure from your lease liability to calculate your right of use asset. Okay, so lease liability we calculate at the present value. Okay, so this is how we calculate fixed payment. Maybe you are making some fixed payment to the lessor, or the payments could be variable, or there are some residual value guarantees. Okay, purchase options. Purchase option means under the lease there's an option that at the end of the lease you can purchase this asset from the lessor. Okay, so to purchase that asset you have to pay him some additional amount. That's why that purchase option also you have to take, but there is some condition attached to that purchase option. That's why you can see a small star over there. Then termination penalties. If any of the party has terminated, they have to pay a penalty. If you have terminated, you have to pay this penalty to the lessor. Okay, so right of use asset. How do you calculate right of use asset? Initial liability value. Now do you understand why you are calculating liability liability first? Least liability has to be calculated first, because right of use asset is starting with initial liability value. If there are no other changes, then lease liability and right of use asset will be same amount. But if these things are there, then it will change. What are these things? If you have made a payment before or at the commencement, you have to add this with initial liability value for your right of use asset. If there are any direct cost, if there are dismantling cost, then you have to add it with initial liability value and calculate that will be your right of use asset. But if there is no direct cost, no dismantling cost, no payment made before or at or before the commencement, initial liability, okay, your liability will be same as right of use asset. That is your initial liability value. Okay, and those two star marks for purchase options and termination penalties include if reasonably certain to be incurred. That means if the the lessee is very sure that he's going to purchase that asset at the end of the lease, he's going to take that asset, he's going to buy that asset permanently. If he's very certain, then only it will be taken under penalty. Sorry, the lease liability. And termination penalties also. If he's very sure that he's going to terminate the lease, the lessee is very sure, then he has to make this payment to the lessor, and and he has to include it in the liability at present value. Okay, if the last two, if very sure, but the fixed variable and residual value guarantee you anyway have to pay. There, you whether you're sure or not, you still have to pay. I mean, for fixed and variable, you don't have to be sure. You anyway have to pay, right? So now lazy accounting has to do some things more, but this is for subsequent treatment. That was at initially you are recognizing a right of use asset and lease liability. What about subsequent treatment at the reporting year? At the end of reporting each year, you have to do this. Your lease liability will change, your right of use asset also will change. Why? Because your lease liability will increase by the interest charge. Remember, it's a liability, lease liability, whatever it is, it's a liability. And liability, every liability you have to pay an interest. So under lease liability also you have to pay an interest. It's like how you pay interest on a loan. So lease liability also, interest has to be paid above that value of that lease that you have to pay to the lessor. So because of that interest, your lease liability will increase. That means interest has to be added with lease liability, your initial value of lease liability. Okay, and this interest is recorded in the statement of profit and loss because it's an expense. But if you are making any cash repayment to the lessor, it will be reduced from the carrying amount of the lease liability. That means you deduct it. So add interest, deduct cash payment from your lease liability and find the carrying amount of lease liability. For right of use asset, okay, initially you just measure it, but subsequently you have to find the depreciation also. You have to depreciate it. Okay. So this one is measured using cost model. There is no fair value or anything that comes here, or no such option that we have for normal asset. We measure it using cost model only. That means unless another measurement model is chosen. If any model is chosen, it will be told to you in the exam. But if it's not told, default position is cost model. Okay, so that means cost less accumulated depreciation and impairment losses. It might be impaired like how any other asset is. So that also, if impairment losses is there, you have to deduct it. Okay, so you have to depreciate right of use asset. Then remember a few minutes back I have told you that there are some exceptions where you don't have to recognize right of use asset or lease liability. These are these two exceptions. Number one, short term lease. That means lease which is less than 12 or 1 year, less than 12 months from the date you have started the lease. It is known as short term lease. Or the lease is of low value. Low value means when you have first purchased that asset, it is of low value. See, car, you cannot say, even if the value of a car is less today, you cannot say car is a low value. Why? Because initially when you buy a car, any car, it's expensive. The value is very high. Okay, so in terms of number, they didn't set any criteria or any range like that this is known as low value or below this, no. But for your SBR exam, if anything is of low value, examiner will mention it for you. Okay, so then you have to say it is exempted. Okay, but for the short term or low value lease, what should you do instead if you are not recognizing right of use asset or lease liability? The lease payment, you are taking it in the profit and loss account. It's an expense. The lazy is doing it. Okay, for him is a payment. It's an expense, so he will record it in the profit and loss account on a straight line basis. Straight line basis means, let's say the lease is for 3 years, so for 3 years he'll be recognizing that lease payment. Divide by 3. Lease payment divide by 3. Every year he'll be paying that lease payment. Okay, so that means it's simple. Okay, the rule is simple when it's short term or low value. Next, we are going to the lessor accounting. So that's it for the lessee accounting. Okay, make sure that you know the rule of lessee accounting, that they recognize right of use asset and lease liability, because we need this under sale and lease back also. Lessor accounting. So lessor is the one who is giving the lease. Okay, so for lessor accounting, the main thing is classification of finance and operating lease, whether it is a finance lease or an operating lease. Okay, what is a finance lease? Finance lease means risk and reward of having that asset, that ownership is transferred to the lessee. You have transferred it. And operating lease means you didn't transfer it. It's not a finance lease. Still you are the one, still lessor is the one who is bearing the risk and rewards of having that asset. So there are some situations, okay, which tells you that it's a finance lease or not. That means risk and rewards has been transferred to the lessee. Number one, ownership is transferred at the end of the lease. So ownership is transferred to the lessee means it's a finance lease, because risk and reward has passed to the lessee. Lease, the lessee has the option to purchase. the asset at the end of the lease term for less than the fair value. Less than that fair value, he will be uh, buying that asset. He has that option. Okay, then it's a finance lease. Lessee continue to lease the asset at the end of the lease term for less than the market rent. Okay, he continues to lease the asset at the end of the lease term. That who is doing it? Lessee. Lessee has taken a lease from the lessor. After that, lessee is now leasing it to someone else, but for less than the market rent. So because he's leasing it for less than the market rent, for lessee it's a risk. It's a loss for lessee. He is bearing the reward of this risk of this. That's why it's a finance lease. Okay. Lease term is for the major part of the asset's life. That means asset's life is 5 years, and out of 4 years is lease term. Under 4 years, it was under lease. It's a finance lease. The present value of the minimum lease payments are substantially all of the fair value of the lease asset. That means minimum lease payment that you are making, the present value of it, it is equal to the fair value of the leased asset. All of the fair value of the lease asset. That shows that lessee must have given that fair value of lease asset to buy that asset. That's the reason why it is known as finance lease. That means risk and reward is transferred to the lessee. So under all these conditions, risk and reward of ownership is being transferred to the lessee. Just check. Whenever you are in a doubt in the exam, whether it's a finance operating lease, just check who is having the risk and ownership. Is it transferred to the lessee or not? If it's transferred to lessee, finance. If not, operating lease. How do you account for it? For finance lease, okay, the lessor must do this thing. De-recognize the lease asset. Why? He has sold it to the lessee. It went to the lessee. So lessor de-recognize it. But recognize instead what? A lease receivable. Why? He is going to pay, he is going to recognize a lease receivable. He is going to receive this amount from the lessee now. Right? Amount is being receivable. He is going to get this amount, which is known as lease receivable. It's like how you, when you give your sales on credit from your customer is your receivable, right? You are going to receive from your customer. So this is also same way. You are going to receive from your lessee. That's why you have to recognize a lease receivable. At what amount? At the present value of the minimum lease payment. That means whatever lease payment you are receiving from the lessee, the present value of it plus any unguaranteed residual value of the asset. Okay, unguaranteed. You can go and check in your textbook what is this unguaranteed granted residual value of the asset. Okay. Next, recognize income. Okay. So recognize an income. It's like how you are taking a credit on sales on credit. You recognize a sales also. You recognize receivable also. So same way you recognize a lease receivable. You recognize income on the lease also. But this is for the lease. Okay. Recognize income on the lease receivable using what? Rate implicit in the lease. Rate will be given to you in the lease. So based on that, you can recognize income also from this lease. It's an income for you. You have sold the asset to the lessee. So it's an income for the lessor. Now we are going to the operating lease. Okay. So operating lease, what the lessor has to do? Lessor has to continue and recognize and depreciate the lease asset. Because see, under operating lease, lessor didn't sell the asset to the lessee. Lessor is still having that asset with him. That's why he can recognize also, he can depreciate that lease asset also. Second, he is going to receive rental income from the lessee. So he has to recognize this rental income in profit and loss on a straight line basis. If it's for 5 years, he's going to recognize this lease rental. For 5 years, he has to, if he's going to receive it for 5 years, so over 5 years, he's going to recognize this lease rental income, right? Because for him, it's an income. Lessee is the one who is paying you. For you, you are a lessor now. So you are receiving this income under operating lease. Sale and lease back. So this is the final topic that we are going to touch under IFRS 16 before we end IFRS 16. Sale and lease back. Because sale and lease back, it is often confusing for students. What I did, I am showing you a demo. Okay, this is some imaginary I have built it, right? It's not from any textbook. Okay, so let's assume A owns an asset. Okay, whenever I say A, let's assume it's you. You and me. Okay, so you are A, I am B. So you are owning an asset and he is selling to B. So who is a seller and who is a buyer here? A is a seller because he is selling. B is a buyer because he is buying from A. Now, what did A do? A sold his asset to B. After selling his asset to B, before he was to own that asset, now he is using that asset again, but he's not buying that asset. He is using that asset under lease. He's leasing that asset. That is called as sale and lease back. First he sold to B, now he is using it from B, but under lease terms, under a lease contract. You understanding? So now A takes back on lease. He's using that asset again, but under the lease from B. So the arrow is reversed now. Okay. Here we are not going to say buying a buyer or seller. You cannot say this became seller, A became a buyer and B became a seller. No. He's taking on a lease. That means who is a lessor and who is a lessee now. The one who is using that is a lessee. So A is a lessee. And B, since he's giving that to A to use, he's a lessor. So can you see? A, if you see the condition of A is a lessor, seller and a lessee. So seller is the lessee and buyer is the lessor. This is what I have put in conclusion. Seller is the lessee, buyer is the lessor. Okay, and sale or not sale is the question under sale and leaseback. This is what you need to do. That's it. Whether it's a sale or whether it's not a sale. If it's a sale, it will be calculated. It will be the treatment will be different. If it's not a sale, treatment will be different. That's what we are going to do under this table. Okay, so I hope that demo was quite useful. Now, so under this depends on whether that sale represents the satisfaction of a performance obligation under IFRS 15 or not. Why? To recognize revenue for the sale to happen, that means you have satisfied your performance obligation under IFRS 15. Then only you can say it's a sale. So there are these 4 boxes that you need to know. If the transfer is not a sale and if a transfer is a sale. First we are going to go through if transfer is not a sale. Okay. We went through that demo, that seller is a lessee, that is A, and buyer is the lessor, that is B. Okay. The reason I have shown you that demo first is because now when I explain you this table, now you will not get confused. Okay. So whenever I say about seller, think about A, that A in the box, who is first owning the asset. Now he sold to B. Now he is using that asset again from B, but under lease. So this is not a sale. Let's say this is not a sale. Sale has not taken place. I mean, they have recognized it as a sale, but it's actually not a sale under IFRS 15. Then how do you recognize it? Then the seller continue to recognize asset because not a sale. Not a sale. So recognize the asset. Who is recognizing the asset? The seller. Because the seller didn't sell, so he will recognize. He will continue to recognize the asset. And instead recognize what? He will recognize financial liability equal to proceeds received. It is a little bit strange, no? That we are talking about IFRS 16 here. Then we jump to IFRS 15 talking about sales. Now we jump to financial liability, which is IFRS 9. Why so many things? Why financial liability he has to recognize? Asset part is okay. That is about selling and buying asset. But we have a lease also there. A lease back. So because of that, we have to recognize a financial liability equal to the proceeds received. You have got that proceed. Even though it's not a sale, but when you sold that asset to B, B have given you some amount. So equal to that amount that you have received from B, you are going to recognize a financial liability. You cannot recognize it as a profit. Why? Because it's not a sale. But instead, what are you going to recognize if it's not a sale? Recognize a financial liability. Why? Because you are a lessee, you have to pay this amount to the lessor. The amount that you have got from the lessor as a proceed for selling, because it's not a sale, you have to pay this amount back to the lessor. Okay, the same amount, but you will recognize it as a financial liability you have to pay. What is the definition of financial liability under IFRS 9? Obligation to pay cash. or obligation to pay a financial asset. So financial asset we cannot say here because we don't know what type of asset, but cash, yes, you have to pay the lessor. That's why. So seller, the lessee, is recognizing financial liability. Okay, if you understood this part well, you will understand for the buyer it will be reversed. Buyer will not recognize the asset because he didn't buy asset. Because if it's not a sale, how can he buy the asset? Control will not go to him, no, the buyer. So he will not recognize the asset. But what will he recognize instead? Financial asset. Because financial liability for the lessee will be the financial asset for the lessor. He's going to receive this cash. He have a right to receive this cash, the lessor, from the lessee. That's why he will recognize a financial asset. Same, equal to the transfer proceed. Coming to the transfer, if the transfer is a sale, what the lessee is going to do, what the lessor is going to do, seller and buyer. Okay. So remember, he is going to de-recognize the asset now. Why? Because now it's a sale. So seller is going to de-recognize. That means buyer is going to recognize the asset. But we'll go to buyer later. First, let's finish the seller part. Seller, because he's a lessee now, he first de-recognized the asset. He sold the asset. Now he's going to recognize not the whole amount of asset, only the right of use asset, because he's using it under lease, no? So recognize right of use asset has the proportion of the previous carrying amount that relates to the right to retain. How are you recognizing this right of use asset? As a proportion of the previous carrying amount. Previously, what was his carrying amount? Proportion of it that relates to the rights that is retained. That means you didn't sell it off. The rights that you retain, that you have to use that asset. Definitely, this also you have to do questions. There are questions on this sale and leaseback with figures, with numbers. You have to do it from your revision kit. I don't remember the question number. There are so many questions I have done. I have done many questions on this. So you have to go back and do these questions to understand this better. Just memorizing this table is not enough. If you are not understanding with numbers what's happening, and if you are not able to calculate, okay, then we recognize a lease liability because he's a lessee, remember, so he has to recognize a lease liability also. And because now it's a sale, there will be a profit or loss also on disposal. That also seller has to recognize. Now coming to the buyer, because he bought, it's a sale, he will account for it as an asset purchase, and he's a lessor. So all the lessor treatment he will use, accounting requirements, whether it's an operating lease, finance lease, it's not needed because it's not clear cut. If in the scenario they give you that this is a finance lease, then according to finance lease he will account. If this says no, it's an operating lease. But if it's not clear which type of lease, then just say account for lease under lessor accounting requirements. That's enough. So this treatment you should know, and don't go and put a box like this in your exam. Okay, this is for your understanding purpose, so that you understand all the scenarios that I put it together. But you have to write in proper sentence. Okay, if you understood this, if you understood the demo that I went through, this is nothing, this is very easy. So that's it for IFRS 16. And from your exam kit questions, these are the questions given to Anok and Jenny. I have done the first two. Okay, the questions which I didn't do, inshallah I will be covering it for the December exam. So the next will be the last IFRS standard, which is IFRS for SME. Okay, so till then, thanks for watching.